Do you feel like you finally got some traction with your money, but you often find yourself wondering exactly what to do next? Well, in this video, I'm going to walk through 3 financial orders of operations, discuss some of their nuances, and offer my own personal take on each of them. By the end, you'll walk away with a menu of financial roadmaps to choose from to help you gain the clarity and confidence you need to know that you're putting your next dollar to its highest and best use. If that sounds good to you, stick around. Welcome to Refactor Your Money. I'm Max, an accredited financial counselor, here to help you break free from financial stress and start living a life of purpose. Now, if you've been following my previous videos about cash flow, net worth, financial ratios, I really hope that you've found that you're starting to get a little bit of traction with your finances. Maybe you have some positive cash flow. Maybe you've started tracking your net worth and you're tracking your spending, or you have a budget. If that's the case, you're making some great progress, and you may be wondering exactly what to do about that. You've got some cash or some money left over at the end of the month. You may be wondering, what the heck do I even do with this? Well, I want to discuss 3 different financial orders of operations that can help you answer that question. Now, before we get into the 3 different orders of operations, first I want to discuss exactly what an order of operations is. Now, as I've mentioned in previous videos, I'm a software engineer by trade. It's what I do for my full-time job. And we are all about orders of operations, right? It's basically just an algorithm. We work with these all the time. It's just a series of decision gates or logic gates that say, hey, once you achieve this, now do this. Or if you are here, go do that, right? So it basically helps you answer the question, what should I do first? Or if you've already started, what should I do next? Now, let me give you an example. So if you grew up in the United States, like I did, there's probably a really good chance that when you were in elementary or middle school, you learned about PEMDAS. Now, that is the order of operations for mathematical equations. So it just helps you to understand exactly what order in which to evaluate any given math equation put in front of you, right? And it's an acronym. Sometimes it's also referred to as, please excuse my dear Aunt Sally, right? PEMDAS. And each of those letters stands for a particular operation. So the P is for parentheses, right? So you always evaluate the parentheses first. Any parentheticals in the equation, you do that first. Then you move on to E, which is exponents. After you get to exponents, you get to M and D. M and D are multiplication and division. You always handle all multiplication operations and division operations before you move on to the last 2, A and S, which are addition and subtraction. So keeping in mind PEMDAS, you can essentially start to evaluate any equation put in front of you, right? You just think PEMDAS, you think about what each of those letters in the acronym means, and you can work your way through the equation. Now, the beauty of PEMDAS is that it's essentially universally accepted, right? No matter where you are in the world, any continent you might be on, we all basically agree that that is the way mathematical equations are evaluated. Now, the problem is that in personal finance, it's not quite that simple, right? There is no one universal PEMDAS. And part of that is because each country has its own different rules about retirement accounts or taxes or what have you, right? So not every single location in the world necessarily allows for a universal order of operations. So the 3 financial orders of operations that I'm going to walk through are, number 1, Dave Ramsey's Baby Steps. Number 2, Reddit's Prime Directive, which is born of the subreddit Personal Finance on Reddit. And number 3 is the Money Guy's Personal Financial Order of Operations, otherwise known as the FOO, F-O-O, for Financial Order of Operations. So for each of those 3, I'm going to put an image of the order of operations basically up on the screen. I'm going to walk through what the steps are so that you have a sense for what they mean. And then I'm going to talk a little bit about some of the nuances and my own personal take on what makes each of them unique and who might be a good fit for each one of them. So let's dive into that. Okay, starting with Dave Ramsey's Baby Steps. This is a 7-step plan. You start in step 1, you move up to step 7, you tackle each one by one. When you finish the first one, you move on to the next one. So I'm going to put the plan up on the screen and I'm going to walk through each step. So here you go. Now, step 1 is to build a $1,000 emergency fund. So if you're just starting out, you're probably just getting a handle on your cash flow. You're reducing your spending. You may be going out and get a second job to increase your income or advocating for a raise at work or what have you, right? So you're starting to get some positive cash flow. You're now having money left over at the month instead of month left over at the end of the money, right? So you've got that money coming in. You're thinking, what do I do with this? Step 1 is stash it away in a high yield savings account until it reaches a value of $1,000, right? So that's step 1, super basic, just save $1,000, and that's for an emergency. So if something like a car repair or an injury or something that requires some sort of immediate cash infusion, right? Some sort of cash cushion that you need to fall back on. That's what that's there for, so that you aren't derailed completely and having to lean back onto credit cards or some other form of debt or credit to get yourself through an emergency and then have to get right back in the debt cycle. So that's step one. Step two is to pay off debt with a debt snowball. Now, I'll do a whole other video on different ways of paying off debt and this concept of power paying with the debt snowball and the debt avalanche. So you can keep an eye out for that video soon. You list it out from lowest balance to highest. So start with lowest, go up to highest, not interest rate, balance, right? How much is left on it? And you just start knocking it out. So you pay your minimum payments for each one, and any remaining money you have left over as cash flow, you throw it at that one at the top, the one with the lowest balance. You just do that step by step for each different credit line or each loan you have until they're all wiped out. And that is then considered the end of step two. Once you've got that knocked out, you move on to step three, which is saving up 3 to 6 months of living expenses. Tracking your spending is key here, right? Because you can't know what your living expenses are until you've tracked them, right? You need to, in order to know what 3 to 6 months even means, you have to know what 1 month means, right? So you need to track your spending for a month. You need to have a budget. You need to be sticking to it. You need to understand, okay, I spend X thousands of dollars a month. I need to multiply that by either 3, 6, 4, 5, what have you, whatever you decide. You just keep cranking your cash flow the same place you have that $1,000 saved. Now you start putting money into that. You just pile it on top until you get to that 3 to 6 month number. So that's step three. Step four is to start investing 15% of your income into a Roth IRA or other retirement account at work if you have one provided by your employer. This often means a pre-tax account. I think I've discussed these in previous videos as well, where money is withheld from your paycheck and diverted as a contribution into an employer-provided retirement account. Otherwise, if you have your own IRA, an independent retirement account, or a Roth IRA, you start contributing into that. And you do that until you reach 15% of your total gross income, right? So if you make $100,000 a year, you're putting in $15,000 a year, setting that aside in either a company-sponsored account or an independent account of your own. And that is step four. Once you hit that mark, you can start putting some money away for college. So if you're a midlifer who has kids, I myself am one of these. I have 2 kids. It's important that we consider whether we want to be paying for college for them, right? And if we do, we're going to have a way to save for that. So this is the step where you start doing that. You can either save in an UTMA or an UGMA. I can talk more about those in a future video, or a 529 account, which is a tax sheltered savings account specifically for education expenses. You can do that. But the gist is you start putting away money for college in this step, step 5. Once you feel satisfied with the amount you're contributing to college and setting aside for your children's future education, now you start moving into paying off your house. So if you're a homeowner, if you do own a house and you've got a mortgage on that house, this is the step where you start cranking everything that's left at that house, paying off the mortgage and getting that balance down to 0. The idea here is that not only does this increase the amount, it's going to increase your net worth by paying off your debt faster, but it's also going to free you up once you hit 0 and pay it off completely. It's going to free up more cash flow for you, right? So you won't have anyone owning your home but you. No one can come and take it from you. The bank's not going to come knocking on your door asking for that debt to be repaid. And now you've just freed up whatever your monthly mortgage expense used to be, your minimum monthly mortgage expense. Now you've got that money running free for you. You can put it wherever you want. You can start doing whatever you want with it next. And that brings me to step 7, which is build wealth and give. So this is the point where you can start doing, this is where you're really, really getting into living a life with purpose, right? This is where you are starting to decide, okay, what are my values? What do I really want this money to be? What purpose do I really want this money to be serving? And you're starting to put it to that purpose. So maybe you want to retire a little earlier. You don't want to wait till 65. You want to put that money in something like a brokerage account where it can start growing and as an investment, as a stock investment, and you have access to that money. It's pretty liquid and you can use that to retire a little bit earlier, right? You just start shoving money in there on a monthly basis, let it grow. That's one option. You could start investing in real estate on the side, trying to get some rental properties or something. Well, this is the point where you can start putting money to a different use based on your own value system. And you can start doing things like giving, right? You can start tithing if you're spiritual or you're part of a religious congregation. You can start giving money to charity, right? You can start using some of this wealth and this abundance that you've earned through these other previous 6 steps and start putting that to another use. So that's step 7. That's the final step. Now, some of the key takeaways from Dave Ramsey's baby steps that are going to make it unique to some of the other operations I'm going to show you next are really 4 things. The first is the basic emergency fund in step 1. is $1,000. So you're going to see in the next two operations I talk about, that number is going to be different. So for Dave Ramsey, it's $1,000. Next is that it calls for a 15% savings rate once you get to step 4, right? You start actually putting money into retirement accounts and investment accounts. So remember that 15% number in future orders of operations when comparing and contrasting. Next is that it calls for contributing to a college fund or setting aside money for children's future education expenses prior to maxing out retirement accounts, right? So it's putting your child's education ahead of fully maxing the IRS allowed maximums for tax sheltered or favorable tax treated retirement accounts. And then lastly is that it defines high interest as non-mortgage. So in step 2, where you're paying off all your non-mortgage debt, you'll see in future orders of operations that's often called the high interest debt payoff phase. Here it's just any non-mortgage debt. So Dave Ramsey, for the purposes of his order of operations, basically considers anything that's not your mortgage high interest. He wants you paying off all of that before you move on to the next step, regardless of the interest rate. Now, in terms of my own take on this, there's some interesting things to think about here. So number 1 is that it's the order of operations with the fewest number of steps. So if you're someone who kind of likes the simplicity of fewer steps, this could be a really great fit for you. It's 7 steps. You'll see the next couple of orders of operations I talk about are going to have more than 7. So if you're someone who likes the idea of having fewer steps, but steps that maybe take slightly longer to get through, this could be a good fit for you. Another interesting quality about this order of operations is that it really leverages money psychology. Step 2, he calls for using the debt snowball. Now, that one, as I mentioned, is all about ordering your debts from lowest balance to highest balance and knocking off the lowest balance first. There are alternatives. There's debt avalanche, which calls for ordering by interest rate, so knocking off the highest interest rate first rather than the lowest balance first. There's some psychological advantages of the lowest balance first, in that you start feeling like you're making some progress, right? The smallest balance is the easiest one to just eliminate the fastest. So there's sort of a psychological tailwind of knocking that out right away as the first thing. And you start feeling like you've got some successes. Maybe you've got some momentum. So it sort of leverages that psychological benefit of knocking off smaller debts first. Even if mathematically it may not be the fully optimized way to do it. And then number 3 is if you're a person who really, really, really hates debt and having any amount of debt is stressful and anxiety inducing for you, Dave Ramsey might be a good option for you because he really is anti-debt. His order of operations calls for knocking off debt far sooner than both of the other 2 operations you're going to see. So if you are a person who cannot stand debt, or you just love the idea of being completely free of any sort of monthly burdens, any sort of debt payments, Dave Ramsey's Baby Steps could be a good order of operations for you. So that's my take on those. We'll move on to number 2 next. Okay, order of operations number 2 is called the Prime Directive. Now, this comes from a subreddit online from Reddit. It's the personal finance subreddit, and it was created there by the users in that community. Again, it's called the Prime Directive, and it's basically 7 phases. So where Dave Ramsey was 7 steps, the Prime Directive is 7 phases, and within each phase are lots of nuanced sort of logic gates and logic flows, yes/no questions, right, that take different types of actions based on the answer. So it's a much more granular and nuanced. If you're the kind of person that likes detail, it's a good option for you. So I'm going to put that up on the screen now. It's pretty big, but I'm going to walk through the top level phases first, and then I'll put a link in the description below, the full Prime Directive display, the full graph. So if you want to dig deeply into exactly what's within each phase and what the logic gates look like, you can do that. So high level phases, I'm going to lay those out above, and I'll just highlight each step as I go, starting with the first one. Now, the interesting thing about the first one is that it is not called phase 1. It's called phase 0. An engineer like myself kind of likes this. We work a lot with zero indexing in software. And basically the idea behind phase 0 is that you're really getting the basics down first, right? You haven't actually really started progress, right? Like actual advancing down the ball down the field. You're basically doing preparation work. So step 0 is basically budget, track expenses, and start setting realistic goals for yourself. So again, if you've been watching any of my previous videos, learning about how to track your net worth, how to create a cash flow statement, how to track your spending. Maybe you've done a full financial checkup by using all those ratios that I've talked about in my previous video. You probably are at least making good progress through step 0, if not having already fully completed it, right? Maybe you have a budget, you know what your expenses are, You know how much money you have working for you each month, right? What your cash flow is. So that's really step 0, is just nailing all that stuff down. So that's where you start. And that's basically just like sharpening your axe, right? You don't start chopping the tree till the axe is sharp. And it's like a measure twice, cut once kind of thing. Then we get into phase 1, and this is where we really start putting in the work. So much like with Dave Ramsey's step 1, you're gonna build an emergency fund, right? So phase 1 is build an emergency fund. In case of the Prime Directive, the emergency fund is not $1,000, it's instead 1 month of expenses. So again, this is where phase 0 comes into play and why it's so important, right? You gotta be tracking your expenses. You can't know what 1 month of expenses is until you've tracked a month of expenses. You have to have that number available before you can even start working towards this target, right? So phase 1 is save up 1 month of expenses. And again, you should have an idea what your cash flow is. So you should be able to calculate out about how long this is gonna take you, but that's your first objective. And again, the purpose of having that is to keep your financial life out of the ditch, right? In case something goes wrong, you get run off the rails, you've got some money that you've got a 1 month worth of expenses to fall back on, right? If there's a medical emergency, if there's a car accident, what have you, you want to have a month of expenses saved up and ready to fall back on if you need it. So you're not dipping into credit cards or some other form of credit or debt that's going to set you back. So once you've conquered phase 1 and you've got that 1 month of living expenses saved up in cash in a high yield savings account, you're ready to move on to phase 2, which is employer-sponsored retirement accounts. Now, much like with Dave Ramsey, where he talks about stashing 15% of your gross income into Roth IRA or company-sponsored retirement account, it's the same thing here, right? So if your company offers a retirement account, you want to start contributing to that. Now, the difference here is Prime Directive doesn't call for 15%. All it calls for is hitting your company match. Now, what does that mean? Well, most employers, if you're a full-time employee or even a part-time employee and you have access to an employer-sponsored account, will match contributions you might make to this account yourself up to a certain percentage. So, for example, at my place of employment, my company will match dollar for dollar my contributions up to 4% of my pay. So, if I have a $10,000 income, and I'm contributing 4% of that, that is a $400 contribution each month. My employer will match that by putting in its own $400, which leads to an $800 total contribution, right? The reason this is important is because if I put in 4 and my employer puts in another 4, that means I'm getting a dollar for dollar. So every $1 I put in is another $1 added. Now, if you think about that in terms of actual monetary returns, that's a 100% return on investment, right? You're putting in $1, you're getting $1, right? And then that 100% is then gonna be going into an investment, right? In theory, you should be putting your money in some sort of fund within your retirement account. And then that's gonna continue to grow, right? So you want to, at the very least, hit that employer match. So that's phase 2. Whatever your employer-sponsored account is, figure out what percent they'll match you at and hit that, right? You don't have to go any higher, just hit the match and move on, right? So at that point, you can move on to phase 3, which is pay down high and moderate interest debt. Now, for the purposes of the Prime Directive, high interest debt is considered anything above 10% interest rate. So this will often be credit cards, right? That's the most likely thing to be above 10%. So you hit that first. You can do, just like Dave Ramsey, you could do debt snowball, or you could do debt avalanche. You pick your poison on that, but that's your goal. Now you're using whatever leftover cash flow you have each month to slam that high interest debt, right? You're paying that down. You are in this part of phase 3 until that high interest debt is paid down. Once you've paid down all of that high interest debt, which is again most likely going to be credit cards, you got all your credit cards paid off. Now you can move on to moderate interest debt. But again, there's some nuance here. So this is the point in the Prime Directive where you are encouraged to go back to phase 1, which is the emergency fund phase. And now you want to start bolstering your emergency fund from just 1 month of expenses to now 3 to 6 months. And again, just like I've said a number of times here, it's up to you whether you go 3 to 6, right? You can choose 3, you can choose 6, you can choose 4, you can choose 5, you can choose 4.5. I don't care, right? You decide what's best for you. But this is the point where high interest debt is gone. Phase 3, high interest debt, bam, you've annihilated it. Now all you have left is moderate and low interest debt. This is the point where now you go back and you bolster your emergency fund. So if you have a layoff or you lose income in some other way, right? Some sort of catastrophe where now you're out of work, your income evaporates. Now you're going to be able to survive for 3 to 6 months while you figure out a way to replace that income, right? So this is it's kind of like a weird thing, but you go from phase 3, it's like almost like phase 3A. You finish that, you swing back to phase 1, you knock out the emergency fund all the way up to 3 to 6, then you swing back to phase 3, and this is where you tackle phase 3B, which is moderate interest debt. Now, what is moderate interest debt? Now, moderate debt is anything above 4 to 5%. Now, that excludes your mortgage. So if you've bought a house in the last few years, which is the case for me, you probably have an interest rate that is above 4. You may have an interest rate that's above 5. I do. Prime Directive calls for excluding that from your list of moderate interest debt. So the most likely thing to fall into this category is going to be probably either student loans or a car loan, right? Those are going to be things that are going to be like 6, 7, 8, 9, 10%, somewhere in that range. Those are the things you're knocking off next. So just like you did with the high interest debt, you line it all up, you pick your approach, you pick your strategy, you pick Snowball, Avalanche, you start knocking off anything that's above 4 to 5. You can choose whether you want to do 4 or 5. You just start knocking that stuff out, right? Same as before. Once it's annihilated, now you can move on to phase 4. So now all you should have left at this point, coming out of phase 3, is just your mortgage. That should be the only debt you have left on your balance sheet. So once you've got all your high and moderate interest debts cleared out and eliminated, right? You've vaporized them, they're out of your life. Now you can move on to phase 4, which is starting to invest in an IRA, Roth or traditional, and starting to save for any other big anticipated expenses coming up for you. Now, traditional and Roth IRA, I can talk more about those in a future video because there's a lot of details and nuance around those. But the gist is that these are independent accounts separate from your employer. You open it up yourself with the brokerage firm of your choice. And basically what you do is you contribute money throughout the year up to the IRS limit, which I think, if I remember correctly, for 2025 at the time of this recording, is $7,500, so $7,500. With a traditional IRA, the way you do that is you contribute, right? Then at the end of the year, you deduct that amount from your taxes, so it doesn't count as income, and you get that invested money, then grows tax-free over time, and then when you retire and you pull the money out, you then pay those taxes, right? So you got the deduction this year, you didn't pay taxes on that money for this year, you'll instead pay when you retire and pull the money out. A Roth IRA is the opposite. So you pay the tax, so let's say you got paid from your job, right? You've now got the money in your bank account. You're going to put money in that Roth IRA and you are not going to claim any deductions for it. You're just putting it in. The money on those dollars, or the taxes on those dollars, has been paid. That money is going to grow tax-free over time. And then when you retire and you pull it out, you do not owe any taxes on that money because you paid it at the entry point when you put the money in. So there's all kinds of ways to determine which of those two is best for you at this moment. I can talk about that, like I said, in a future video, but that's what you're going to be doing here. And you're going to be trying to hit the max if you can, the $7,500 max. And it may be different based on when you're watching this video. So double check what that is. And then the other part of phase 4 is going to be saving for anticipated required large purchases. So that could be, and these are purchases for you, right? So this is not college for your kids. This is maybe higher education expenses for yourself. If you're going to go back to school and finish college, you need some sort of professional certification or something, or some sort of qualification to go earn some more money. Or if you have like a vacation you're planning, or you're going to need a new car in the next few years, this is the type of stuff that you're putting money away for. So you're trying to max out your Roth or your traditional IRA, and you are saving up a chunk of money that you define, right, based on your needs in a savings account for whatever that upcoming required purchase is going to be. Or once you've got that stuff set up, done and gone, you've got the chunk of money there, and you've got your IRA and Roth IRA investments rocking and rolling. Now you can move on to phase 5. Now, phase 5 is saving even more for retirement. Now, much like Dave Ramsey, the Prime Directive calls for increasing your contribution, right? So if you remember from phase 2, this is where we started contributing to our employer-sponsored account up to the match. Now what we're going to do is increase that contribution up to 15%. So if your company match threshold is 4%, like it is at my job, you're probably just contributing 4, your employer's matching 4. Now what you're going to do is you're going to increase that contribution as far as you can until you hit 15%. So in my case, it would look like I put in 15%, my employer continues to match 4. So I'm getting a total of 19%, right? So this is the phase where you do that. You should really start cranking into retirement. You want to get that number as close to 15% as you can. And once you get to 15, once you're able to achieve 15%, you have cleared phase 5. Okay, and then step 6 is going to be saving for other goals and starting to use some advanced investment techniques. Now, this is going to be things like an HSA. If you have a high deductible health plan through your employer, you likely qualify for an HSA, which is a health savings account. And basically what this is it's essentially like a 401k for your healthcare, right? So you put money in pre-tax, it grows tax-free, and then as long as you use it on medical expenses, you can pull it out tax-free. So this is where you start looking at that, putting money into that. This is also where you start thinking about your kids' college, right? And if you are like me, I have kids. I am middle-aged and I'm starting to think about college for them. Well, I'm not thinking about them going to college, but I'm thinking about the fact that they need to go to college and that's going to cost money, right? And you might want to be thinking about whether you want to pay for that for them. So this is the phase where you start doing that. There are savings vehicles for that. You could open up a 529, start putting money into that. Or you could just be putting money in, if college is coming up soon, you could just be putting money into a savings account for that. And this is also where you're starting to think about whether you want to retire early or whether you're interested in a rental property or some sort of vacation house or some other sort of longer term goal that's going to require you setting money aside for it, right? This is where you start thinking about that. This is basically those three things, the final phase. Once you're here, you're rocking and rolling. You are crushing it. You are well on your way. So thinking about the nuances here of this particular order of operations, if comparing it and contrasting it to Dave Ramsey and the FU, which is coming up next, some details here to keep in mind, some notable things. Number one is the starter emergency fund amount, right? So with Dave Ramsey, step one was to save up for that $1,000 starter emergency fund. Here with the Prime Directive, it's 1 month of expenses. So there's a decent chance that your monthly expenses are going to be more than $1,000. $1,000 is like, to the Dave Ramsey, $1,000 number has been like that for years, decades probably. And life has inflated, lifestyle, cost of living pretty much everywhere has inflated quite a bit since that $1,000 was first established. And that $1,000 number has stayed the same on his steps. So there's a good chance that your 1 month of expenses is going to be far more than that. So the advantage here is that you have that larger starter emergency fund in the Prime Directive. The second thing is that, and this is a way in which it's similar to the baby steps, is that it also calls for a 15% savings rate before you start moving on out of phase 4. Now, another notable detail here is that the investment rate Prime Directive calls for you to target in phase 4 is 15%. Now, this was similar to Dave Ramsey. You'll remember from his order of operations and his baby steps, he also called for 15%. So that's a similarity here. And then just like with Dave Ramsey, the third notable thing here is that the Prime Directive also calls for prioritizing college funding and setting aside money for saving for college prior to fully maxing out your retirement account, right? So there's a decent chance that 15% of your income is not going to get you to the IRS maximum allowed annual amount for retirement contributions. So you'll hit 15%. It's going to be a really good chunk of your income. It's probably not, in most cases, going to be the full 23.5 that the IRS allows. So in that way, the Prime Directive does encourage you to start saving for college before you max out your retirement accounts. And then the final nuance here, and this is again a contrast, not a comparison, this is that the Prime Directive considers anything high interest greater than 10%, whereas Dave Ramsey calls for paying off all non-mortgage debt in the exact same baby step. There's no sort of distinction between high and medium. So that's another thing to keep in mind here. Now, in terms of who the Prime Directive is a good fit for, it is, just like Dave Ramsey's baby steps, it is 7 steps. They're called phases for the Prime Directive. They're 0 through 6 instead of 1 through 7, but there are 7 of them. So if you like having like 7 sort of defined, sort of like a shorter number of defined actual steps or phases, this could be a good fit for you. The other thing that's great about the Prime Directive is that because there's a phase 0 there, it really does put a focus on the fundamentals. So it really does ensure that you are locked in and really have a solid handle on the foundational behavioral pieces before you start getting into the actual movement of the financial picture, right? Moving on to phase 1 and 2 and 3, right? It really forces you to focus on step 0 and get that really, really nailed down before you start moving on to the other stuff. And then the last thing is that this is a great advantage of the Prime Directive, is that it has a supporting decision tree. And I'll see if I can put a picture of it, just like it's pretty huge, but I'll see if I can put like a huge screenshot of it right here for you. It's pretty involved and it's pretty detailed. So if you're the kind of person that likes to have that stuff broken down for you and give you sort of that yes/no decision tree, The Prime Directive is a fantastic way to do that. And so if you're that type of person, I would definitely recommend the Prime Directive for you. Okay, and that brings us to the third and final order of operations that I want to discuss. And that is the Money Guys Financial Order of Operations. That's what it's officially called, and it's affectionately known as the FOO, F-O-O, for Financial Order of Operations. I'm going to put it up here on the screen if I can, so you can see it. First thing I want to highlight here is that the Financial Order of Operations is 9 steps instead of 7. So Dave Ramsey and the Prime Directive are 7. The FOO is 9. But those steps are broken into 3 phases. So step 1 is having your deductibles covered. Now, you'll remember Dave Ramsey's baby steps call for a $1,000 starter emergency fund. The Prime Directive calls for 1 month of living expenses starter emergency fund. The FOO, the Financial Order of Operations, calls for your highest insurance deductible being covered. Now, what this means basically is your insurance deductible is the amount that you are responsible for paying out of pocket yourself for any sort of covered loss before the insurance company starts taking over covering for that loss for you, right? And paying the expenses for you. So there's a good chance you have health insurance. If you own a home, you probably have home insurance. If you drive a car or own a car, you're going to have auto insurance. You may also have something like you may have renter's insurance. You may have life insurance, right? There's other types of insurance. But what you're going to want to do is you're going to want to list out all your insurance policies. You're going to look at all the deductibles for each one. You're going to list those out and compare them, right? And you're going to pick the highest one. Now, what that highest one represents is your personal financial exposure to an emergency loss, right? So if you break your leg playing soccer or something, or you get in an auto accident and you injure someone, or there's a leak in the roof of your house, or a tree falls on your house or something, whatever, right? And you have a claim for that loss with your insurance company, you are going to have to pay a portion of money, an amount, your deductible, until the insurance is going to start covering that for you. So you need to have that amount stashed in cash and available. So if an emergency does come, just like with the other orders of operations we've discussed, you can handle that and you're ready for it. So step 1, highest insurance deductible covered. So again, list out your deductibles, pick the highest, that's your target, and all your cash flow is going into a savings account until that account hits that highest deductible number. Step 2 is the employer match, and you'll remember this also, this will sound familiar from the Prime Directive. You're going to look at your employer's match for their sponsored retirement account, and you are going to contribute that amount up to that match. So again, for me, it's 4%. I would start contributing up to 4, get my employer to match that. Once I hit 4 and I'm able to contribute 4, still have cash flow left over, step 2 is done. I'm moving on to step 3. Step 3 is high interest debt. Now, the interesting thing about high interest debt, and what I really like about this financial order of operations, is that high interest debt is defined differently than the Prime Directive and the baby steps, in that it is a phased approach by age. Now, the way this breaks out is if you are 30 years old or under, high interest debt is considered anything above 6%. Now, if you're 40 or under, or in other words, between 30 and 40, that's going to be 5%. And if you're 40 or over, it's 4%. Now, if you're 30 or under, you probably have, or you may have, student loans, right? And student loans could be under 6%, right? So there's a chance that student loans do not fall into high interest debt until you eclipse 30, at which point, okay, maybe it's a 5.5% interest rate, right? And at that point, now you are trying to hit that hard. And the reason for that, the reason that there's sort of this phased age approach, is because it allows you to build your foundation early in life and not be overly focused on debt pay down, but it then also ensures that you are circling back to it and you are chipping away and knocking it out before you get too far down the road where you're into your 50s and 60s and you still haven't fully paid the thing off. So that's the phased approach for high interest debt. Now, obviously things like credit cards are of course going to fall into those categories. There's a good chance a lot of car loans could as well, depending on your credit score. So that's also something to keep in mind. But step 3 is knock out your high interest debt. And again, you can choose Snowball method, Avalanche method, totally up to you. Once you've got that all cleared out, all your high interest debt is gonzo. Now you move on to step 4, which just like the other ones is to save up an actual true emergency fund. And that is again, 3 to 6 months of expenses, up to you whether you choose 3 or 6. Again, you can watch a previous video of mine if you want to see a little bit more nuance about that. But that's step 4. Once you got that taken care of, you got that chunk of money set aside. Now you move on to step 5, which is Roth and HSA. Now, step 5 does not include a traditional IRA, it just includes Roth and HSA. And the reason for that is because generally, the younger you are, the more advantageous it is to contribute to a Roth IRA and an HSA. Now, the reason for a Roth is because generally when you're younger, you make less. So you're more likely to qualify for a Roth. And you also probably are in a lower tax bracket at that point. You're in a pretty low tax bracket, so you can afford to take that hit now, put that money in the account, let it grow for decades, and then when you retire and you're likely making more money, or you will be pulling more money out from various income sources, you're probably going to be in a higher bracket by then. So having that money be able to come out tax-free is an advantage, right? And the HSA I talked about in the last section about the Prime Directive, that's money in, tax-free, growth tax-free, money out tax-free as long as you use it for expenses. So that's step 5. And that is, again, maxing out. So if you can max out your Roth, max out your HSA, right? Once you hit that, assuming you qualify for both of those things, you can move on to the next step. You can also move on to the next step if you either don't qualify for an HSA, meaning you don't have a high deductible health plan, which personally I do not. So I do not have an HSA because I've never had a high deductible health plan. I've got a family with lots of medical needs, so we don't have a high deductible plan. And if you start making over a certain amount of money, once you get later in your career and you start making more and more money, you may also not qualify for a Roth IRA anymore because there are income limits on that set by the IRS. So you can also move on to the next step if you don't qualify for either or both of those things. Now, step 6 is to max out your retirement. Now, this again is different from the previous 2 orders of operations in that it doesn't just call for 15%, it calls for a full max out. Now, again, in 2025, the year of this recording, that is $23,500. You can have an extra $6,500 on top of that if you are over the age of 50. So this calls for you to fully max that out. So calculate what that is as a percentage of your salary if you're a full-time employee, or you can just put in a set dollar amount, right, incrementally over time for the course of the year to hit that $23,500 or full $30,000 if you're over 50. And once you achieve that, you can move on to the next step. Now, the next step, step 7, is hyper-accumulation. Now, this is where you are starting to think about, much like in the final step of the Prime Directive and the final step of the baby steps, you're starting to think about, okay, where else can I max things out here? Are there any other opportunities to do like a mega backdoor Roth, or do I want to max out a traditional IRA in addition to my Roth IRA, right? So you're thinking about other ways to sort of start to hyper accumulate. You might be someone who is interested in retiring early, so you might open up a brokerage account. That's a taxable account where the money goes in after taxes, and then as you can pull it out freely whenever you want, but there will be capital gains taxes, either short or long term, based on when you pull that out. Once you're satisfied with the hyper-accumulation part, now you can move on to prepaid future expenses. Now that is where college comes in. So if you have a child or children and you are interested in paying for some or all of their college expenses, this is where you start doing that. So this is where you're going to want to start thinking about potentially opening up a 529, putting that money in, letting it start to grow tax-free so that it's there and available for your kids when they hit college age. So that is step 8. Once you've hit that, you're satisfied, you're on a good trajectory, you feel like, okay, I'm going to have the money I need for my kids. This is where now you circle back. Step 9, final step, is to pay down low interest debt. Now this is where we go back to the phased age definitions that we talked about in step 3, and you're going to now be paying off debts below those thresholds. So if you're under 30, that would be anything under 6. If you're between 30 and 40, anything under 5. If you are older than 40, anything under 4. So this is where most likely your mortgage starts to come in, right? This may also be where if you have a really, really low interest car loan or really low interest student debt, this is where you start slamming away at that, making sure that that is gone and done. And that's where you're really, really, really fully freeing yourself from debt. So that's step 9. Now, to get into some of the nuances about this one, there's 4 things to keep in mind in particular. Number 1 is, again, the starter emergency fund threshold. From Dave Ramsey, it was $1,000. From the Prime Directive, it was 1 month of expenses. Here in the FU, it is your highest deductible covered. So that's a nuance to keep in mind. Number 2 is that it advocates for a higher savings rate than the previous 2. So you'll remember from the Prime Directive and the baby steps that those call for a 15% savings rate and savings and investing rate, right, for your 401k and various other purposes. The FU, if you were to go and read their detailed blog post, which I'll see if I can post it, I'll probably down in the description. They also, I think, have a whole video about it. They advocate for a much higher saving and investing rate, 25%, right? So they talk about maxing out your retirement. They talk about hyper-accumulation, right? The hyper-accumulation phase really means get up to that 25%. So whether that is distributed through all your retirement accounts, your available retirement accounts, and a brokerage account, or just if 25% is just your 401k, maybe you can do all 25% your 401k, right? But that's what hyper-accumulation really is. It's hitting that 25% threshold. The next nuance to keep in mind is that the FU really does prioritize investing in yourself before investing in your kids' college. Now, the reason for this, and I generally tend to agree with this, is that it's really important to make sure that you yourself are taken care of, right? This is like an airplane oxygen mask scenario where you put the oxygen mask on yourself before assisting others, right? If you are not in a good place financially yourself and you put all your money towards your kids, guess who's going to be living in their kid's basement in their old age, right? None of us want that. Our kids don't want that, certainly. And there are loans available for school, right? Kids can take out loans for college. You cannot take out loans for retirement. So that's really the crux behind that particular nuance. You got to get yourself set up first. Take care of yourself. Circle back to your kids with what you have left over. And if you're able to do it, you've got everything locked in and optimized, there's a decent chance that your kids will be able to be just fine, right? And then the last nuance is that phased approach, right? The age-based phased definition of high interest debt. So that is, again, if you are under 30, anything over 6. If you're between 30 and 40, anything over 5. And if you're 40 or older, it's anything over 4. Now, I think this one is a really, really great fit for anyone who feels okay with debt, not okay with it, but is sort of comfortable with carrying a little bit of it and really values investing over debt pay down, right? So you'll remember from these different steps that paying down debt really comes, it's early in the process to a point, but investing is really the heavy focus here. And so if you really value investing over debt pay down, this could be a really good framework for you to use. Next up is that it's very focused on optimization from a mathematical perspective, right? Whereas Dave Ramsey was very much leaning into and harnessing and leveraging the psychological momentum sort of based approach of using the debt snowball versus the debt avalanche, and really focusing on paying off debt and freeing yourself psychologically from any sort of financial sandbag. This one is much more math-based. So this is for someone who has sort of a technical, mathematical optimization type of mind, which is, frankly, is me, as you probably guessed, since I'm a software engineer. I sort of gravitate to the FU. So this one is great for that type of person. And I really think the FU also does a fantastic job of working in and weaving in nuance, right? The age-based definitions of high-interest debt are a good example. Also, the deductibles covered thing is another great example. The target that you set for your starter emergency fund, right? It's sort of this acknowledgement that everyone's financial situation and everyone's life situation is completely different, and that just $1,000 across the board is not necessarily going to be right for you, right? Your deductible is really the thing that you're going to be responsible for in an emergency, and everyone's deductible is going to be totally different. So the FU really does a fantastic job of both weaving in that nuance and also accommodating each individual person's situation, a unique situation, and adapting the order of operations to really fit those needs. So that's the FU. So in terms of which one you should choose for yourself, I'm just going to highlight a few advantages of each one so that you can sort of pick the one that you think will be the best fit for you. So in terms of Dave Ramsey's baby steps, I'll put him back up on the screen for you again right here. This is great for those who are debt averse, might be more motivated by psychology than math, and is great for those who might be willing to work a little bit longer for the benefit of being able to prioritize their kids' education. Reddit's Prime Directive is fantastic for those who value starting with the fundamentals. It's very detailed, and there are lots of different paths to complete the framework. And much like the Dave Ramsey baby steps, it's probably a good fit for those who might be okay with working to traditional retirement age in favor of prioritizing their kids' education. Lastly, the Money Guy's FU, the financial order of operations. This is great for those who want certainty that they're going to be able to have emergencies covered and avoid financial setbacks early. It's great for those who are motivated by the purity of optimization over the psychological tailwind benefits. It's great for those who are willing to accept more nuance when it comes to the definitions of high interest debt. And it's also a good fit for those who don't have kids or are willing to prioritize their own needs and their own retirement. ahead of their kids' college education. It also might be a good fit for you if you're interested in retiring early or prioritizing leaving a legacy outside of college education. In terms of which one I chose for myself, I ended up going with the FOO, and the reasons for that are a few. First, as a software engineer, shocker, no surprise, I like optimization, right? I'm really into the data, the numbers. I want to make sure that it's done the fastest way possible using actual math. Some people are not like that. I just happen to be. That's the way my mind works, right? Secondly, I don't really want to work until traditional retirement age. I'm kind of interested myself in retiring a little bit early, and the financial order of operations really helps support that with its 25% savings rate. So that's one factor for me. And then lastly, is that I'm very fortunate, and my wife and I are very, very lucky that when our kids were born, their grandparents chipped in a little bit to their college educations. So that really lessened the burden for us to have to be as focused on that, and allowed my wife and I to really start prioritizing our own retirements and our own hyper-accumulation, our own sort of savings needs and our own goals for the family as a whole over simply just our kids' college education. So because we got a slight head start, which is obviously extremely privileged, and I'm crazy thankful for that, the FOO just ended up kind of being a better fit for our particular scenario. So I hope that was helpful to you. I hope now you've got a good sense for 3 different sort of money maps that you can consider traversing yourself based on your own needs and your own psychological characteristics. And in addition to that, I want to offer you a few things. So I'm really passionate about getting people on the right track with their money and helping them live a life of purpose. I really believe that if we all live a life of purpose, that the world will be a better place. Being able to have your money under control and harness it for your own value system and your own beliefs, I think it really has so much power and so many benefits that ripple out throughout your sort of circles. And so I want to help you get there. So I want to offer you a few things. First, I want to offer you my personal financial tracking template. I've done a video all about how to use it. Well, a couple of videos actually, all about how to use it. It's totally free. I'll put a link for it in the description below, but it's a great place to start if you are interested in tracking your net worth, tracking your expenses, and really starting to get some traction with your money, sort of that phase 0 stuff from the Prime Directive. Second thing I want to offer you is my 30-day money refactor guide. It's also totally free. It's a tool I use in my own coaching practice with my clients, and it's something that I spent some time doing myself early on in my own journey. It's just really a great way to just get a sense for like what matters to you, where's your money going now, is it going to the places that you care about, and really start giving you some clarity about where you stand today and help give you sort of a North Star and some guidance on where you can go next. You can do it within a month. It's just a 1-month exercise, super simple, really gets you some momentum. And again, link in the description below, totally free. And then third thing is if you are someone who is interested in a little bit of extra guidance, a little bit of sort of one-on-one hand-holding, I do financial coaching. As I said in the beginning, I'm an accredited financial counselor myself, and I love helping people with their money. So there's a link down in the description below where you can schedule a call with me, a one-on-one focused coaching session where we can go through your situation with all your specifics. I can help give you some ideas, talk you through some things, and help get you on the right track with your money. So please go ahead down below in the description and sign up for that. And then the fourth and final thing is, this is a small channel. I'm really trying to grow it. I really want this to be valuable for you. So if you would please like, subscribe if you got any value out of this, and also tell me what sort of problems you're facing in the comments below. I really want my videos to be helpful for you. This is all about you. And I've got my own ideas, but I really want to build videos and make videos that are helpful to you and based on things that you have your own questions about. So please answer that question down below in the comments. I would love to hear it. So I've got some ideas. I've got some videos planned to answer some of those questions. So those will be coming out shortly. But I'd love to continue to hear more ideas. I'd love to get some more backlog going of that. So please do comment down below. And other than that, I think that's it. I'm going to let you go. I hope this was valuable, and I will see you in the next video. Thanks.